Hi friend, this is Pawan Sharma. How are you? In this video, we would be talking about how to identify bad stocks. You must have heard a lot of time that this stock is about to give a breakout, this stock will be next multi-bagger, and this stock can give you 30% return in next few months, next few years. And there are a lot many speculation that could be there in the market regarding that stock. But when you are actually taking that stock, I would request you to do your own analysis, and while doing that analysis, what all steps you have to keep in mind, what all things you have to understand to actually identify that stock, whether the stock is actually good for investment or not, or actually that stock is absolutely a bad stock. So let's talk about that. And if you haven't subscribed my channel yet, please go ahead and subscribe to it. That way you can support me a lot, and do not forget to press the bell icon. This is my English channel. If in case you are looking to understand everything Hindi, then I have another channel which is for Hindi. You can also subscribe to that. The link will be there in the description box for the same also. So let's talk about that, and let's understand that how to identify those bad stocks. First thing, more debt. I wouldn't say that just on the basis of debt you can say that the stock is a bad stock. You must have heard of that all the banks are under debt. That's not actually debt, but yes, they have given money to a lot of companies, to a lot of industries, individuals, businessmen, and overall they have that money is a kind of debt until that money is recovered back. So just on the basis of debt, you cannot say that the stock is bad stock. So please, if you look out for any screener, like there is one popular screener, screener.in. When you go there and when you check a particular stock, and when after checking that, when you see that the debt is there, please make sure that you look for other things also. But yes, for companies which are not performing, for companies where the other parameters are not supporting, then of course debt is one of the main component also in finding that particular, to identify that stock. So yes, if company has a lot of debt, if company is not performing, not making profit, and the debt is increasing day by day, then definitely that stock is a bad stock. You cannot pick that stock for long term, because the more the company will earn, the more they will try to reduce their debt, and ultimately as an investor you might not get that returns, you might not get the benefit from the same. Fine. So the first component which you have to look out for that into that stock is the debt of that company. And if the debt is like huge, at times you must have seen that the company market cap is like 1000 crore, 2000 crore, and the debt is almost, I would say, 3000 crore, 5000 crore. So more than the company total capital, and the company is not making profit also. Continuously the company is making loss. So that is where you have to say no, whatever you're saying wrong, and I will not take that stock for my investment. The second is low promoter holdings. There are a lot of stocks where the promoter are only holding 5%, 7%. At times I've also seen 1% of their own company, which means they have no credibility. If they have to quit, they can quit anytime, and public who are holding their stocks will be in big loss. Most of the time they have pledged their stocks, pledging their stocks to other banks, to other companies for the bonds, debt bonds, and there are so many things which are there. Let's take an example of VDL. VDL is making a very good profit. They are giving a lot of dividend also, and but the debt is there on that company. Recently you have heard of about the promoter holdings. They have almost the like very low percentages with them, rest is pledged with the banks. You must have heard of Adani Group. Adani recently, after that Hindenburg report. So in that report it was said that they are making a lot of manipulations and all, but they came clean from there. While doing so, they have, like we have noticed that during that period that Adani Group was pledging their stocks, but now they are once again buying back their stocks. So they are increasing their promoter holding so that investor will feel confident in them. So that way if a company is buying back, that's a sign of like, even if they are pledged, that's a sign of growth. But if they have really low promoter holding, I would suggest you should say no, this stock is not for me. And please make sure that the promoter holding should not be less than 50%. Or maybe like the startups are there, the new companies are coming up, and they don't have that much holdings, but still the promoters are also there, not the public. The promoters must be there, the main person and the promoters, the combined the holding should be like, I would say, decent kind of holding, and they should be not pledged, right? Then we have is a return on investment. Of course, we are investing in stocks just for returns. If our stock is not giving us returns, there is no point staying into the stock. If the stock hasn't given good returns in the past also, that stock is not for us. Say no and move on. If the stock is giving you less than 15% return year on year, I would say stay out. That's the minimum I would say that you should look for, that at least more than 10 to 12% returns should be there. If it's below that, I would say not a good stock. The next point is profit dipping constantly. Of course, as we say, when we're talking about debts and when we're talking about promoter holding, it simply indicate that company is not making money. If company is not making money, then even if the company is debt free, I'm not talking about debt, the company which has debt, I'm saying debt free, there also we cannot invest. And if the company has a debt, the company promoter holding is low, the profits are dipping, it's a big no. It's like a red flag for us that you don't even have to look further, just move on. So the next point will be the profit is continuously dipping. And guys, if you want to, like, if you haven't subscribed my channel, please first go ahead and subscribe and then move on. And if you want to know more about intraday, then you just watch this video that is there available on my YouTube, that's in Hindi, and the same is available in English also. So the link will be in the description box, you can check this out. Then we have high PE of the stock. At times when we are talking about this Adani group, why this Adani came into my mind, the PE of the stock was going through like 125, 150. So that high PE is not good at all. So whenever you see the stock PE is really high, like I would say 20, 25, 23 is fine. Of course, there are few like volatile stock, their PE can stay above 40 also. That is also fine. But if the stock PE is beyond 100, 150, 125, then it's a big red flag, because with that high PE, the stock might not sustain that particular move. It will definitely go for profit booking, because that is overvalued. That stock is overvalued, and to come back to the fair price, to come back to the fair intrinsic value, the stock will definitely go for profit booking. And there, if you are entering at that particular time, you might be in loss. So if the stock has high P, you can just go with the rest of the industry P. If the stock has really very high P as compared to the industry standard, so maybe as compared to that particular sector, please say no and move on. Then we have is constantly falling APS. It's just like earning per share, just like the profit. So if you don't know about all these formulas, ignore, just focus on that. If the company is not making not giving you returns, if the company is not giving good profits, the company might be giving good profit but you are not getting the benefits, that is also a red flag. So if the company EPS is falling, stay out. Then we have is company management. Recently you must have heard of that the company has gone bankrupt. The company was like it was in news because of dump and pump policy. A lot many things are there. It simply indicate that the company management is not good. There are a lot of company promoters, there are a lot of company management which are always under scrutiny or maybe under observance, because they are famous for their acts. So please go through the company management also, go through their past also, that if they have done the similar kind of scam in the past companies, if yes, then definitely they will be doing the same company also, stay out. So company management is one important factor. And guys, hope all these things, all these steps, if you just club together and if you start looking on those screeners, make sure that you identify your bad stocks. So hope all these steps will help you to identify these bad stocks, and that way you can stay out from your bad investments also. So thank you for watching guys, and I'll see you into my next video. Have a nice day. Take care. Bye.